If you don't understand how the dollar system works, you are misunderstanding innovation, interest rates, and gold all at the same time. The mechanism is simple and yet beautifully hidden. The United States issues the world's reserve currency, and that forces global capital to subsidize American risk. By the end of this video, you'll see exactly how that subsidization works, why it distorts markets, and why liquidity keeps on winning even when policy says it really shouldn't. So here's the payoff up front. American innovation is not primarily funded by genius. It's funded by cheap, patient failure. And cheap failure exists because the dollar is not just money. It is the global requirement. When a country issues the world's reserve currency, global trade settles in its money. Global savings are forced into its assets. Global risks get absorbed onto its balance sheet. Now, that's not confidence. This is not admiration. It is necessity. And necessity does one thing. It collapses the cost of capital. That collapse does one critical, huge thing. It buys time. Time to lose money. Time to be wrong. Time to repeatedly fail without being shut down. That time, not intelligence, is what creates innovation and breakthroughs. So remember this. The dollar buys time. So why does this matter? Well, here's the problem. The same system that makes failure survivable also makes discipline fiscally, financially, monetarily optional. And once discipline becomes optional, markets stop pricing that risk in correctly. That's where bubbles form. That's where rates stop working. And that's where gold, silver, palladium, platinum, Bitcoin starts keeping the score. Now, this is really a Bitcoin channel, so I delete the last comment on Bitcoin. Because necessity creates permanent demand, and permanent demand does something profound. This is what happens. It pushes interest rates lower than they should be. It keeps capital available longer than it actually deserves. It allows projects with no cash flow to survive for years. Now, that gap between what capital should cost and what it does cost is the real subsidy. Not grants, not tax credits, liquidity. Liquidity, liquidity. We're back to liquidity. The name of this channel, well, not directly, but the purpose of the channel. Now, other countries have smart people. That's not hidden, right? That's a fact. They have engineers, they have scientists, they have brilliant professors, they have brilliant teachers, they have entrepreneurs. What they don't have is global savings forced into their bonds, a currency the world must hold, capital that refuses to leave. So failure ends careers in those situations. But in the United States, failure often leads to just another round of Series A, Series B, Series C funding. So why does that cheap failure actually matter? Let's be precise here. True innovation is actually inefficient. It wastes money, it burns capital at a huge clip. It fails more often than it succeeds, and that's literally the model for venture capital. That only works when failure is survivable and fundable, when capital is patient and readily available, where capital is cheapest, not where the ideas are actually the most efficient and the best. Here's the rule. Innovation doesn't actually reward being right. It rewards surviving long enough. And the reserve currency system makes that survival actually possible and probabilistic. That's the subsidy. That's the hidden subsidization. That's the hidden engine behind American innovation and exceptionalism. But this is where the mutation actually begins. Systems don't freeze. They tend to evolve over time. I'm not talking about Brownian motion, but I'm talking about an evolution of a different type of order. And when the liquidity stays abundant for long enough, incentives begin to change over time. And capital just stops caring about what it funds. It only cares about things that scale. Think the Ubers, think the Amazons, think the Netflixes. That something is what they can trade. That something attracts the next round of funding. Engineering becomes actually optional. Cash flow becomes theoretical and something into the future. There is a great deal of financialization versus innovation. This is where innovation quietly turns into financialization, and that's what happens in late cycle economies. The goalpost shifts from building durable systems to inflating valuations, from solving actual problems to extending runways and making sure they're fundable, from outcomes to optics, from actual hypothetics to narratives. When capital is free, discipline becomes completely optional, and optional discipline never really ends well. But there's a paradox to this, right? This paradox is the dollar system. The same subsidy that funds breakthroughs also inflates everything it touches. You don't get one without the other. So how is this mechanism going to be exposed, and how do we profit from it? This is why interest rates don't work the way people think. Let me explain. Raising rates doesn't remove the subsidy. It changes where it hides. As long as the world needs those dollars, demand for dollar assets is always going to persist. Capital keeps recycling into treasuries. Liquidity finds a way back into the system somehow. You can raise the price of money, you can't cancel its necessity. So tightening somewhat becomes a theatre. Tightening often feels theatrical and theoretical. Rates rise, yes, speeches sound aggressive, and yet financial conditions still loosen. Risk assets always recover. Liquidity reappears with abundance. Because reserve currency systems leak by intention. They are leaky by design. Control is merely an illusion, but the flow is actually the truth. It's the reality. Remember, the dollar buys time. Raising rates doesn't change that because the dollar buys time. This is where precious metal and hard assets enter the story. Now, gold doesn't rise because people panic per se. It doesn't rise because the headlines are scary or apocalyptic, because it's not actually that fungible and used in a crisis. I mean, try and go and sell a bar of gold in the zombie apocalypse, right? It doesn't happen. Gold rises because reserve currencies must expand by definition, by logical existential reality. They have to. They must be overused. They must leak. They must show slippage. They must subsidize the system. They anchor. They have to do it. That is the cost of being global. That's the cost of being scalable. That's the cost of being the reserve currency. Gold is not betting against America. It's measuring the price of running the system. Gold doesn't actually predict collapse. It just keeps the score, and it keeps the participants honest. Here's the deeper paradox in it all. The dollar funds innovation by making capital cheap. We've established that. But it also funds excesses by making discipline optional. So over time, something really perverse happens. Excess grows faster than innovation. Asset prices outpace productivity. Liquidity outperforms the engineering. This is why markets feel disconnected from reality. Liquidity is always winning. But the systems like these, they don't end suddenly. They don't end in a big bang. They decay. They have a long tenure and they have a long collapse. Innovation undoubtedly slows. Returns concentrate and become ameliorated away. And the risk hides in plain sight. The dollar continues to fund absolutely everything until the world needs it a little less. It's like that famous quote, right, about going bankrupt gradually and then all of a sudden. Now, in the next episode, we're going to talk about interest rates, why high rates don't actually mean tight financial conditions, why liquidity never really leaves, and why markets keep mispricing the consequences. Because once you understand the plumbing, boys and girls, you stop trading the narratives and you start reading the pressure points. So join me in the next episode. My name's Justin Banton. This is the House of Trade. Like, share, and subscribe. Ciao for now.